This chapter deals with plant assets, natural resources, and intangibles. You've seen the term plant assets before. Plant assets are items that are on your balance sheet that have a life of longer than 1 year. We use them longer than 1 year. Typically, plant assets are physical things such as land, buildings and machinery, equipment, furniture, fixtures, land improvements. Land improvements is something new that you haven't seen, but we'll talk about it in a little bit. Now, plant assets have wear and tear and obsolescence, and they don't last forever. With the exception of land, which we assume does last forever, the cost of the plant assets are allocated over their useful life. We call that depreciation. Depreciation is an expense, and we show it on the income statement. Depreciation supports a matching principle, and what we do is we take the cost of the asset and allocate that cost over its useful life. How we allocate it, we'll talk about later. Those are the depreciation methods. But the expense of allocating the cost of the asset is called depreciation. Now we're going to introduce two more other long-term assets that you haven't seen before. The first one is a natural resource. Natural resources are typically things like oil, gas, timber, things that are found on earth that we use up. We harvest them from the earth. When we do that, we call that expense depletion. Another long-term asset on your balance sheet is intangibles. Intangibles are assets that cannot be touched. Basically, they are not real. They are a concept, or they are something that you're purchasing that cannot be physically touched. Examples of intangible assets are copyrights, patents, franchises, and goodwill. We do not depreciate or deplete intangible resources. What we do is we call that amortization. If you've been working for a loan company and you've seen amortization calculations, that's very different. This is amortization of intangibles. It's just like depreciation, but we call it amortization. One important thing about intangible assets is that if a product or a method is developed in-house, you cannot put a value to that and call it an intangible on your balance sheet. Intangibles can only get on your balance sheet if you purchase them. Next, take a look at how to measure and account for the cost of a plant asset. Whenever we measure the cost of a plant asset, we need to include the sum of all the costs that we incur to bring the asset to its intended use. Again, the cost of a plant asset equals the sum of all costs incurred to bring the asset to its intended use. Now let's go and look at some of what these costs may be. Let's say that you are purchasing a land. If you purchase a land, what will go as an asset on your balance sheet will be the purchase price of the land plus any commissions you pay to purchase the land, any survey and legal fees that you would pay, any back property taxes paid, and any grading and removal of unwanted buildings. Let's say you were buying a land and the former owner has not paid property taxes. You cannot buy that land until all the back property taxes have been paid, because the government owns a part of that land for the property taxes. They have a right to the property taxes, so they have the right to sell that land and recover the property taxes. So if you want to buy that land and hold the title free and clear, you have to settle those property taxes. If you have to pay for those property taxes to purchase the land, those taxes become a cost of that land. Also, a very common scenario is that, let's say you are buying a land and there is a building on that land. You just want the land. You do not want to have that building that is already sitting there. So let's say that you paid someone to remove that building. The cost of that removal is a cost of land, because what you wanted was an empty piece of land. So all the costs incurred to bring that land to its intended use will be a cost of the land. Let's look at buildings. If buildings are constructed, architectural fees, building permits, contractors' charges, materials, labor, overhead, and also any interest on funds you borrowed to build that building will be part of the cost of the building. If you purchase a building, you would include your purchase price, any commissions that you paid, any taxes that you paid, and again, any costs to repair and renovate the building. In other words, all costs incurred to bring the building to its intended use would be included in the cost of the building. If you're purchasing equipment, it would be the purchase price plus any transportation costs that we paid, any insurance while it's in transit, any sales taxes or other taxes that we had to pay for that equipment, any commissions, and also the installation of that equipment and testing that equipment will be a part of the cost of equipment. Let's say that you bought a piece of machinery, and when you brought it in to keep it where you intended to keep it, you found that the platform that was going to house it is not strong enough. So you had to build another stronger foundation to hold that equipment. The cost of building that foundation would be a part of the cost of the equipment because that is a cost that you incurred to bring it to its intended use. Now let's look at another asset that you have not seen before. We're going to call that land improvements. Land improvements are things that you do to land that are not part of the building. Parking lots, driveways, signs, fences, sprinkler systems, lighting, all these would be considered land improvements. They are long-term assets and they will be in your balance sheet under long-term assets. Land improvements are also depreciated. We're now going to talk about leasehold improvements, so you can skip that section in your chapter.